The world is changing fast. New technologies are impacting how we think about products, services, and the way we live our lives. Nowhere is this trend more present than in financial services, where new business models and customer expectations are changing our conceptions about banking, finance, and the very nature of money. Welcome to Rebank, a visionary podcast about banking, fintech, and the future. The future of banking is here. Hello and welcome to Rebank. I'm your host, Will Beeson. Joseph Healy is the co-founder and co-CEO of Judo Bank, an SME challenger bank in Australia. Fresh off a $400 million Australian dollar equity raise from Bain Capital and others, Judo is on track to lend $1 billion Australian dollars by year-end. Prior to starting Judo, Joseph held executive positions at NAB, ANZ, CIBC World Markets, Citibank, and Lloyds. From 2008 to 2014, Joseph ran NAB's business banking unit, the largest business banking division in Australia. Joseph and I discussed the state of business banking in Australia, why he needed to start a new bank rather than seeking to reform an incumbent bank from the inside, and the learnings from decades as a traditional banking executive that Joseph is applying at Judo. In addition to the insights we deliver through our podcast and newsletter, Rebank offers advisory services to fintechs, banks, and corporates. Drawing on our experience starting, running, and advising fintech businesses, and our vast network of the most impactful fintech entrepreneurs, investors, and innovators around the world, we help companies make sense of fintech, work through specific questions, and optimize proposition and strategy. For more information about our services, please visit bankingthefuture.com. Thank you very much for joining us today. Please welcome Joseph Healy. Joseph Healy, welcome to Rebank.
Thank you, Will. I'm very delighted to be here.
Yeah, well, thanks. Thanks for joining. Convenient that we managed to overlap in London. You're based in Melbourne, I understand.
Yes, a long way away.
Maybe just quickly for context, intro to Judo Bank in your own words.
We started designing Judo about 4 years ago. We felt that there was a gap that had opened up in the SME banking market that the major banks were not serving well. We wanted to build a bank rather than buy an existing business. We wanted to build a tailor-made, bespoke SME specialist challenger bank that was very focused on traditional relationship banking values, but built on modern cutting-edge technology, where we saw technology as an enabler of our service proposition rather than defining the service proposition. But it was really in many ways going back to the way that SME banking used to be done in terms of being an experienced banker that the customer could deal with, speak to when there were needs. And we felt that the banking industry, and certainly I see this in other markets, not just in Australia, there has been a process over time of industrialization, standardization of the way that banks operate. Sometimes it's done in the name of reducing the costs and balancing cost to income. Now that approach serves the banks well, and it actually serves some segments of the business community well, customer community. But in the SMEs, which is largely an inefficient market in terms of information, we felt that there was a need for a bank that specialized and that provided SMEs the service that they deserve, the service that they're looking for.
Yeah. So one of the fun things about having run Rebank for a while now, this may actually be episode number 150 when it goes out. So we've done a few now, specifically around quote unquote challenger banks or technology enabled banks or digital banks. Use the kind of the term that you like. We've sat down with everyone from computer science trained 20 or early 30 something Tom Blomfield from Monzo, right? Or with Rishi and Joel from Oak North, to the extremely experienced Colin Walsh of Varo, former banking executive at Lloyds and maybe Amex from memory. And everyone kind of comes from a different place in looking to solve a similar problem. And I think that you have decades of experience as a banking executive, most recently running the entire business banking division for the National Australia Bank, the biggest business banking division in the entire country of Australia.
Yes. No, I mean, I have a career over 35 years in banking in 5 different banks. Started here in London with Lloyds, long career at Citibank, and then CIBC Wood, which is a Canadian bank, ANZ Bank in Australia, and then 7 years as the senior executive responsible for the business bank at NAB. And as you quite rightly say, NAB's market share, particularly in small to mid-sized business, was the largest in the country by some distance. It was a very strong SME bank. Over my career, I've covered all aspects of banking. I'm very passionate about the purpose and role that banks, or that banking should play in the economy, have done well. But progressively, over time, I had become quite disillusioned and to some extent frustrated, notwithstanding the fact that I was one of the senior executives inside the company. But there was this trend in banking that was a global trend from what I could see, that was causing the business to become much more industrialized, is the term that I use, much less personalized. In saying that, I don't for a second argue that we should not be pushing technology solutions and making the business much more efficient and easy for everybody to use, both staff and customers. But it's been a long-held belief that a certain part of the economy, and let's call it the SME economy, you have to have a range of options for how businesses will want to use the bank, rather than a one-size-fits-all. There's got to be a range of ways. I mean, technology, online transfer of money, etc. That is, for most business, that is what they want to do for most of the day-to-day banking. But from time to time, they want to sit down and speak with someone about buying the business next door, or about investing in new capacity, or succession planning. And they want to speak to somebody who understands their business and who listens carefully to what they're trying to do and helps tailor a solution for them, both in terms of the capital they need in the business and in managing the risks that the business face. I see that as a skill that is in part technology enabled, as I've described earlier, but it requires judgment. It requires human judgment. Maybe in the future we can look to artificial intelligence to start solving that, but that's for the future. Today, small businesses need someone who can interpret what they're trying to do and apply judgment on whether it's a sensible thing for them to borrow £5 million or $5 billion. And the banking industry has lost that craft. And I call it the craft of SME banking, because you apply judgment. You look at the business through the 4 C's of credit, which is, the first C is, what is the character, reputation, track record of this business owner? Second C is, what is the capacity or the cash flows in the business to service the debt, repay it? And the third C is, what kind of capital or equity capital is in the business as a buffer for the debt? And then the fourth C is the collateral. What kind of security is there as a second way out in the event that there's a default on the repayment of the loan? Now, this is basic stuff, and most people listening to this interview will say, well, there's nothing new in that. But there is something quite significant in the 4 Cs. And the significance is that the banking industry has defaulted to the 4th C when it comes to dealing with most SMEs. And the response of most banks to an SME seeking finance is, how much property have you got as security?
I thought you were going to say computer.
Maybe that's the 5th C, but not. What we want to do at Judo is build a bank that applies that 4C framework in the order that I outlined when it comes to dealing and helping and supporting the SME economy.
I have to dig in here with a question that I don't intend to sound challenging, but one which I'm genuinely interested in your answer to. So you were running the biggest business banking division in the entire country. To make the impact that you sought, however, in the market, on the model, you saw the need to leave that and basically start from zero. Is there a reason why it wasn't possible or expedient to work from within the large existing bank to deliver on your vision?
Well, I think that's a great question. I mean, when you're sitting at the top of a large, complex organization, there are a whole range of priorities and trade-offs that have to be made. The bank can't possibly do everything. And the view inside the bank at that time was that we had a very strong business bank. So let's put all our investments into other things. And essentially, you end up treating your biggest business as a cash cow. You, as a senior executive inside a company, you can't only champion the business that you're running. You have a responsibility to the wider group. And what I found is that the bias or the preferences in the bank were moving much more towards retail banking away from business banking. And there's a good economic reason for that, because post Basel II in 2006, the capital weightings on mortgage lending were a third of the capital weightings on SME lending. And so if you're incentivized to maximize your ROE and the market's valuing you on your ROE and your executive remuneration is linked to that, then there's a natural bias towards shifting money towards the assets or the lending of the highest return. But you have this perverse situation that it's more profitable for a bank to lend to you to buy a weekend holiday home than it is to lend to me as a small business owner, where I could use that capital to hire 10 people. So the industry kind of, in one hand, was influenced by the invisible hand of self-interest and maximizing ROE, and lending to households did that for them. So I debated this at great length because, my perspective on banks, particularly large domestic banks, is that they have a strong social license. I mean, essentially, they're very unlike any other private sector business in that if they look like getting into trouble, the taxpayer bails them out. We saw that happen here in the UK. So apart from having that put option to the taxpayer in the event of difficulty, they're given a license, a privileged license, to undertake activities that other institutions can't undertake without that license. And of course, there's also the government guarantee on deposits. There are a whole range of other things that make banks very special. And given those privileges, with them, in my view, comes a series of responsibilities, a social license. And part of that social license is not to maximize your profit by doing what you think is the best for your shareholders. A big part of that social license is to fulfill the purpose that society has awarded you that license to undertake. And lending to SMEs is a big part of that. But unfortunately, for a whole range of reasons linked to incentives and to stock prices, SME lending has become less than the flavor of the day progressively over the last decade. I feel that's wrong. I feel that there's a big loss to the economy over time, and these things do take decades and decades to become evident, that if you're not investing in providing capital to small businesses, then you're weakening the future prospects of the economy. And so for me, this was a passion. I'd mentioned I'd been 35 years in the industry. I'd always been passionate about the purpose of banks and banking. And I felt that the industry was letting down the SME community. And whilst I had other career choices when I left NAB, I really wanted to pursue this, take a risk. I mean, I was in my early 50s at that time, invest my own capital together with my colleagues, take the risk, because not to do so would have left a life of regrets.
Love it. I'm not sure how to phrase this question, but what you just described has kind of gotten me thinking, right? So you described the way that motivations are shaped at an existing bank, in this instance, NAB. But surely it was the case with all Australian incumbents, banks globally, or at least all over the world, were following Basel II, right? So similar incentives existed, and I think in many cases still do exist in banks globally. On one hand, you kind of, you see a new fintech launch, compelling, user interface or new design or new budgeting tool or whatever, and the initial response is, okay, well, that's fine, but a year from now, everyone's going to be doing it. Do you feel like, I guess, first question, the incentives have changed at all in incumbent banks in terms of specifically business banking? Is there any incentivization to shift resources toward the SME space, i.e., is Judo Bank a concept that's going to be quickly replicated as incumbents see the market opportunity? Or is the structural entrenchment of incentivization at incumbents such that Judo Bank is effectively pursuing a blue ocean opportunity on its own?
Great question. Well, when it comes to the incumbent banks, I think the cultural concrete is set, that their ability to change the way that they operate is nigh on impossible. To use an economic term, they're set on a path-dependent course. They've wired the whole business model. They've de-skilled a lot of the frontline bankers. It's very unusual to find a banker, an SME banker anywhere, that has authority to commit the bank. He or she is obligated to send all the information into a central or regional centre. The core skills that once defined a banker are no longer evident. I mean, there are actually ironically smarter people or highly educated people in the banking industry today than was the case in the past. But few of them have really understood the core essence of banking. You know, the purpose behind banks, the skills that you need to be a good banker. I mean, we have a philosophy inside Judo that you cannot be a banker unless you're first a risk manager, because banking is the business of managing risk. And so when people join Judo, we have them do a 3-hour closed book exam before they get an offer of employment, and they have to pass that exam demonstrating that they understand and they can apply judgment as well as technical skills in evaluating the risk of lending to a small business and how best to structure that risk. So I think that progressively over time, the major banks have lost that skill and that craft. They've set the business model up to take costs out, to standardize, to have a cookie-cutter, one-size-fits-all approach. I think their ability for them to go back and replicate, if you will, the way that Judo is operating in the market, I think that cultural concrete is set. Now, the second part of that question, however, I do see a lot more new business models coming into the market, whether it's a fintech or neobank or a challenger bank. There'll be variations, and I welcome that personally. I feel that the need for disruption, the need for better service, a better customer experience is crying out in the banking sector in the UK and also in Australia. So the more credible entrants that come into the market, offering something different, being really differentiated, that is great news. The key, however, is to make sure that they are credible, because what we can't afford to have happen is a poorly resourced, poorly led banking business being set up and then failing, because the contagion effect on the rest of the disruptors, if you will, could be quite serious.
So I hear you talking and reading between the lines a bit, perhaps. It sounds like there are cost advantages for Judo by having efficient modern technology. It sounds like the human component in underwriting lending, specifically to use the example that you described, is probably higher than at an incumbent bank, because you have perhaps better trained staff, there's more human involvement, there's judgment being applied as opposed to purely computer-based credit scoring models. How do you think about the economics and kind of the sensitivity points in that model? I mean, is there enough cost saving through the technology to make the higher cost of human-led underwriting viable in the long term, or viable at scale?
Yeah, it's a great question. I mean, one of the reasons why we decided to build Judo from scratch was that we wanted to make sure that the operating model was set up in a way that we minimize the amount of bureaucracy and complexity that has a lot of costs attached to it. Now, in any bank, there's going to be bureaucracy. The regulator imposes a level of bureaucracy. But I draw a distinction between good bureaucracy and bad bureaucracy. Good cholesterol, bad cholesterol. Having some good cholesterol is a good thing. You don't want too much bad cholesterol. The complexity of the incumbent banks, the arteries are full of bad cholesterol. Just because of their history and the way they've evolved over time with data technology, complex systems, complex policies, procedures, they have a cost-to-income ratio that may look efficient on the surface, but such a large part of those costs are what I would describe as bad cholesterol or bureaucracy, dealing with complexity. We wanted to build Judo so that we had a cost base that was very efficient, but where 75% of our costs were touching the customer. rather than dealing with the bureaucracy or complexity of the organization. And we watch that as we're building month by month. We look at where are we adding our costs, how close are those costs to the customer experience, and how much of those costs are tied up in the bureaucracy of the company. So I think that's a big thing for us. You only get to do this once. You get to do it well once, and do it well is something that we're very focused on. We're very conscious also that we can't scale the business the way that we want to scale it unless we're investing heavily in technology and in the use of artificial intelligence. That's not a contradiction to the relationship proposition that underpins the purpose of Judo. I like to characterize it using the analogy of an aircraft, flying from London to New York. The real skill is in the first 15, 20 minutes of getting the thing in the air, and in the last 15, 20 minutes landing. 95% of the time involved cruising at whatever height, using that analogy in terms of what we're trying to do at Judo, we should have that as artificial intelligence process. And so the real banker skill craft in dealing with the customer at the beginning of the process. Are you a customer that Judo wants to do business with? Can we help you? And then back to my analogy, that's got the whole process in the air. And then the landing comes when there's complexities or there's risks or there's events that happen, and you need someone to apply judgment to that so that the customer experience is good. There's nothing more frustrating than getting a cookie-cutter approach response to a problem that tells you that this is their policy, it's not about you, it's about them.
How easy or difficult is it to staff the sort of individuals who are managing the client relationships, doing the judgmental credit underwriting? Are we talking about a skill set that's antiquated now that those functions at big banks have been replaced by computers? Are you training new people to do it? Are you finding very qualified people mid or later in their careers who can do it? And then related question, and to what extent, if they are older, more experienced people, do they find themselves at home with the technology that you're asking them to use?
Yeah, no, great question again. So we've got 140 staff today, split between Sydney, Melbourne and Brisbane. We'll double that in about 12 to 18 months. We have found that our proposition has been attractive to good bankers who are frustrated with the processes and bureaucracy of where they're currently working, and who can pass our credit test. So no matter how strong your CV is, and no matter how well I or one of my senior colleagues may know you, there is a no exception rule that you've got to pass the test. But what we have found is that we've been able to attract, I would say, around about half a dozen what I would call absolute A-grade bankers in their mid-30s to mid-40s. They've been able to attract A-grade people that they worked with in other places. And so where we are today, I'm really happy with the caliber of staff. But I can see a problem because the market for the kind of skills that we are seeking is a very shallow market. And so our approach to that is to develop our own bankers, bringing in graduate or people who have been a couple of years' experience, and putting them through a rigorous training. Everybody that joins Judo has to do the level 1 of the Chartered Institute of Bankers course. We encourage people to do level 2 and 3, but everybody has to do level 1 because we want to re-establish banking as a real profession in the Australian market, banking SMEs. So our journey of building our own workforce through bringing in a lot younger people from business schools or from the universities, or in some cases people who've chosen not to go into tertiary education but want to work, but are open and willing and passionate about learning, then we will do that. We want an organization that's a learning organization that has very clear sense of what banking should be all about and how it should be done, and that people can feel that we're leading a significant transformation of SME banking in Australia, and we'll be part of that.
Your proposition has clearly found support from a number of leading global investors. I think you guys just raised 400 million Australian dollars.
Over the last 12 months, we've raised $540 million in equity.
Australian dollars.
Australian dollars.
Yeah. Which I think I read makes you one of the best funded Australian startups ever, or something crazy like
Yep.
that, which must be satisfying. Who has been involved early on, and if we look specifically at the $540 million you guys have raised recently, how did that fundraising come together?
Well, I mean, that a lot of hard work. It was led by my co-CEO, David Honery, and the team did an outstanding job. But David and I have been speaking to investors. I mean, we're through a lot of shoe leather in trying to raise equity. We started the discussions with the market about 3 years ago, building relationships with people. At that time we were a PowerPoint, not a business. But we had a story and a very clear sense of how we were going to build a company. We visited investors in Singapore, in Hong Kong, in Beijing, in Abu Dhabi, Dubai, London, and New York. And we had a program of doing that in the first year, 3 or 4 times a year, taking people through our plans. We probably spoke to well over 100 investors or potential investors before we were able to close our first round of equity raising, which was 120 million. But we got an absolute blue chip list of investors spread across the cities and the business centres that I have just mentioned, together with some high net worth family money in Australia and some private equity money in Australia. The Australian market, ironically, and from an investor point of view, was somewhat more reluctant to get in behind Judo early, largely because there was no real history of challenger banks or neobanks in the Australian market, and the consensus was that the major banks were so entrenched, so strong, that it was hard to see how anybody could challenge them. Whereas with the global investors, particularly in London and in New York, they were very familiar with the model and could see how nimble challengers, could take on the big banks.
To wrap up, I want to ask you to depart from what we've discussed already, right? Around human-led credit underwriting, around more emotionally intelligent relationship management with SME clients, and even kind of the incentivization at incumbent bank executive teams. What else have you brought from your extensive experience as a senior manager at banks around the world to your experience at Judo?
Building an organization that's agile and is comfortable making decisions. That I mentioned earlier that banking is fundamentally in the business of managing risk. The more you understand the risks and the nature of risks, then the more you can take risks intelligently, price them properly, and know how to manage them. So that experience has meant that we were able to get moving on things with a high level of confidence, make decisions, accept that not everything was going to work out as you had planned, but when things are not working out, deal with them really quickly, empower people to make decisions and support them in doing so, and also be able to paint a picture for people who were thinking of joining Judo that showed how we could build this into a very credible bank, sizable bank. We built the strong foundation. We started with the end in mind. We have a very clear sense of journey and destiny. And that comes with experience. It's one thing having the best technology in the world or the best idea on new product development. But ultimately, you've got to build a scalable business, at least in my view. Part of the motivation, part of the legacy that we want to leave behind is that we have built a substantial business that is a market leader in the provision of SME banking in the Australian economy. Never going to be the biggest, because I don't think that's a measure of anything, but we can be the best. And management expertise, financial capital is one thing, human capital is critical, cultural capital is even more important. And we focused on those things. And experience allows you to do that. I can talk about Judo in 3 years' time. I can visualize it. It'll be 3-4 times bigger than it is today. And I know that along the way we'll make mistakes and we will hit bumps on the road, but we won't panic. And so that experience with a strong passion, a clear sense of purpose and vision are some of the qualities that you bring, and not being afraid of getting things done.
Love it. Well, I would encourage everyone to check out Judo if they haven't spent time looking at it yet. Joseph, you and your team are doing fantastic stuff, and I wish you all the best.
Thank you, Will.
Joseph Healy, thank you very much for joining us today.
My pleasure.
Thanks for tuning into Rebank. If you like today's show, reach out. Follow us on Twitter at Rebank Podcast and join the conversation. For more on banking, fintech, and the future, check out our regular content at www.bankingthefuture.com.